News yesterday, President Trump addressed last week's stock market turmoil caused by confusion around his tariff agenda.
In the past few weeks, the U.S. stock market has been rocked by a staggering $4 trillion loss in market value. Investors, businesses, and everyday Americans alike are panicking because of the effects of this financial turmoil, and many are wondering what exactly is causing this steep drop. While there are numerous factors contributing to the market's instability, one particularly significant event has flown under the radar but could have lasting global ramifications. Japan's decision to sell off a significant portion of its U.S. Treasury bonds. For decades, Japan has been one of the United States' largest creditors, holding hundreds of billions of dollars in U.S. debt. These bonds have helped finance the massive U.S. national debt and have acted as a stabilizing force for the U.S. dollar. But now, Japan seems to be distancing itself from U.S. financial markets, selling off tens of billions of dollars in U.S. Treasury bonds in recent months. This unprecedented shift in Japan's investment strategy raises major questions about the future of the U.S. dollar, global financial stability, and the relationship between the U.S. and its largest economic allies. The primary trigger for Japan's decision to reduce its U.S. bond holdings is the U.S.'s tariffs on Japanese electric vehicles. The U.S. has imposed high tariffs on foreign-made EVs, including those manufactured by major Japanese automakers like Toyota, Honda, and Nissan. These tariffs were designed to protect the burgeoning American EV industry, led by Tesla, and were part of President Trump's broader efforts to protect U.S. manufacturing and reduce reliance on foreign goods. For Japan, this move has been a slap in the face. The country is a world leader in hybrid and electric vehicle technology, with Toyota pioneering the Prius hybrid car and Nissan mass-producing the Leaf, one of the world's first electric vehicles. Despite their technological superiority, Japan's automakers find themselves punished by the U.S., with their products becoming subject to heavy tariffs. Japan's frustration with these tariffs has prompted the country to take drastic steps. Rather than engaging in direct trade retaliation, Japan has wielded its financial power, using its substantial holdings in U.S. debt as leverage. By reducing its holdings of U.S. Treasury bonds, Japan sends a clear signal to the U.S. If you continue with these tariffs, we will stop supporting your financial system. This decision is not just a protest against U.S. trade policies, but also a financial strategy to weaken the U.S. dollar, which is the cornerstone of global trade and finance. The unfolding situation surrounding Japan's sell-off of U.S. Treasury bonds has prompted reactions from various stakeholders, each with their own vested interests in the outcome. The U.S. government, led by President Trump and the Federal Reserve, is closely monitoring the situation. The Federal Reserve is likely to take action to stabilize the market, possibly by raising interest rates to attract new investors to U.S. Treasury bonds and offset the reduced demand caused by Japan's actions. The U.S. government is currently evaluating tactics to ease trade tensions with Japan, perhaps by rolling back some of the tariffs on Japanese goods in an effort to prevent further financial retaliation. On the other hand, Japanese officials have been firm in their stance that reducing U.S. bond holdings is part of a broader strategy to reduce dependence on the U.S. Japan is likely to continue its financial retaliation as long as the U.S. maintains its tariffs on Japanese products. At the same time, Japan is likely to increase investments in other markets, particularly in Asia, where it has strong economic ties with China and South Korea. Japan's shift away from the U.S. dollar could prompt other countries to follow suit, further eroding the U.S.'s dominance in global finance. China and Russia have already been reducing their reliance on the U.S. financial system, and Japan's actions may encourage them to take more drastic steps. These nations could increasingly turn to alternative currencies, such as the Chinese yuan, to diversify their financial portfolios. As these countries move away from the U.S. dollar, the U.S. could face growing competition for global financial influence. The implications of Japan's decision to reduce its holdings of U.S. Treasury bonds are far-reaching and could have serious consequences for the U.S. economy. Foreign investment in U.S. debt has been a cornerstone of the U.S. financial system for decades, allowing the government to run large budget deficits without facing the immediate consequences of rising interest rates or inflation. If Japan, along with other nations, continues to reduce its holdings of U.S. debt, the U.S. government may find itself forced to offer higher interest rates to attract new buyers for its bonds. This would have significant consequences for the broader economy. Higher interest rates would mean that borrowing costs would rise across the board. For consumers, this would translate into higher mortgage rates, increased car loan payments, and more expensive student loans. For businesses, higher borrowing costs could lead to slower investment and reduced economic growth. But the consequences go beyond just borrowing costs. If the U.S. is unable to attract enough foreign buyers for its debt, it could lead to a decline in the value of the U.S. dollar. As Japan and other nations reduce their holdings of U.S. Treasury bonds, there will be less demand for the dollar, which could lead to a sharp depreciation in its value. A weaker dollar would raise the cost of imports, which could cause inflation to rise in the U.S. The American consumer would be hit hard as goods from abroad would become more expensive, and global supply chains could be disrupted. Moreover, a decline in the value of the dollar could trigger global financial instability. Since the dollar is the primary reserve currency for many countries and financial institutions, any significant drop in its value would have ripple effects throughout the global economy. U.S. stocks could face even more volatility, exacerbating the losses already suffered by investors. The global economy could enter a period of increased uncertainty as the U.S. dollar continues to lose its dominance. Under President Donald Trump, the United States has increasingly relied on tariffs as a means to protect domestic industries and address trade imbalances. Trump's America First agenda has led to a series of tariffs targeting imports from China, the European Union, and Japan, among other trading partners. These tariffs have significantly raised trade tensions, particularly with Japan, one of the United States' largest trading allies. In response, Japan has used its considerable financial power to retaliate in a way that impacts the U.S. economy. By reducing its holdings of U.S. Treasury bonds worth hundreds of billions of dollars, Japan is sending a clear message to the U.S. trade policies that disadvantaged Japanese companies will not go unanswered. In the past, Japan's holdings in U.S. debt acted as both an economic strategy and a stabilizing force for the U.S. financial system. However, as trade relations deteriorate, Japan is seeking to diversify its financial assets, moving away from the U.S. dollar. The uncertainty around U.S. trade policies is beginning to have a broader impact on global business sentiment. For example, companies in the automotive, technology, and manufacturing sectors have expressed concerns about future investments as they face a volatile and unpredictable trade environment. Many fear that prolonged tariff battles could lead to higher inflation, slower global growth, and disruptions in global supply chains. Domestically, the Trump administration's approach has not only focused on tariffs, but also on reshaping the role of federal institutions. One of the most significant changes has been Trump's executive order to dismantle the U.S. Department of Education. Signed in March 2025, this executive order seeks to reduce federal involvement in the education sector, shifting the control of education policies back to state and local governments. This move, part of Trump's broader efforts to shrink the size of the federal government, has sparked strong opposition. Critics argue that dismantling the Department of Education could undermine federal protections for student loans, civil rights in education, and special programs designed to help minority and low-income students. The order is also expected to lead to job cuts, including thousands of federal employees working within the department. This has prompted legal challenges from various state attorneys general, as they argue that the cuts violate federal employment laws and would have devastating consequences for millions of students and families who rely on federal education programs. Further complicating the issue is the involvement of prominent figures like Elon Musk, who has pushed for privatization and greater efficiency within federal agencies. Musk's backing of the push to eliminate the Department of Education reflects a broader ideological movement within the Trump administration, advocating for market-based solutions and minimal government intervention. However, many argue that such a drastic move would disproportionately affect marginalized communities who depend on federal support to access quality education. While the Trump administration continues to reshape U.S. domestic policy, Democratic leaders have started to take more active stances in responding to these changes. Senator Elissa Slotkin, a moderate Democrat from Michigan, has become a key figure in advocating for more pragmatic approaches to addressing issues like tariffs and the federal government's role in education. Slotkin has emphasized that the Democratic Party needs to move beyond activism and offer tangible solutions to the real-world concerns of American citizens. Slotkin's stance is a direct response to the growing discontent among working-class voters, many of whom supported Trump in the 2016 elections. She believes that the Democratic Party should focus more on policies that directly impact everyday Americans rather than purely symbolic resistance to Trump's policies. Slotkin, along with other centrist Democrats, is pushing for policies that address the rising cost of living, improve healthcare access, and mitigate the effects of tariffs on American businesses and workers. This approach seeks to appeal to disaffected voters who feel that both major parties are failing to address their immediate needs. This is in stark contrast to the more progressive wing of the Democratic Party, which includes figures like Alexandria Ocasio-Cortez, AOC, who calls for sweeping reforms to address income inequality and climate change. The tension between these two factions of the party has become a central issue in the debate over how best to counter Trump's policies. Progressives argue that the only way to make a meaningful change is through bold action, including taxing the wealthiest Americans and implementing stronger social safety nets. Japan's decision to reduce its holdings of U.S. Treasury bonds is a significant moment in the ongoing transformation of the global financial system. As Japan moves away from the U.S. dollar, it is not alone in its efforts to diversify its financial assets. Countries like China, Russia, and India are all taking steps to reduce their reliance on the U.S. and explore alternative currencies and financial systems. For the U.S., this presents a critical challenge. Will it continue to lead the world's financial system, or will it be eclipsed by other powers in a more multipolar financial world? How the U.S. responds to Japan's actions and the broader shifts in global trade and finance will determine the future of the U.S. economy and its place on the world stage. Be sure to like, subscribe, and share this video to stay updated on the latest developments in the U.S.-Japan trade war and the evolving global financial landscape. Finance is starting to shift. But what does this mean for you? Higher inflation, rising costs, and potential economic instability are just the beginning. This challenge isn't just a theory, it's already happening. China's economy is now the second largest in the world, and it has been strategically stockpiling gold, with over 100 tons added in 2023 alone. Similarly, Russia has been diversifying its reserves, selling oil to countries like China and India in currencies other than the dollar. Moreover, Japan, largest buyer of U.S. treasuries, has started to sell off U.S. bonds as an action to lower interest rates in the country. If this trend continues, we could see the dollar lose its status as the global reserve currency, leading to higher interest rates and volatile oil prices. The ripple effects would be felt globally, impacting everything from fuel costs to international trade. The tension between these two nations could be the beginning of a new financial era where the dominance of the U.S. dollar is no longer guaranteed. What does this mean for you? Higher costs, greater instability, and a financial system that is far more unpredictable than ever before. Stay tuned as we break down the forces at play and how this shift might impact your daily life. For decades, Japan has been one of the largest buyers of U.S. treasuries, supporting America's financial stability. However, this trend is now reversing. Japan's government has recently embarked on an unprecedented sell-off of U.S. bonds. This shift is primarily driven by higher interest rates at home. In March 2024, Japan's Bank of Japan, BOJ, raised interest rates for the first time in 17 years, signaling a significant change in its monetary policy. The BOJ's decision to end its negative interest rate policy is a reflection of Japan's desire to strengthen its economy and regain control over its financial situation. Japan's growing defense spending and economic revitalization plans under Prime Minister Shigeru Ishiba require more liquidity at home. Moreover, Japan is increasingly uncomfortable with the U.S. foreign policy, especially in the Asia-Pacific region. Japan's strained diplomatic ties with the U.S. over its aggressive stance toward China have added another layer of complexity to this shift. Selling off U.S. bonds isn't just an economic decision, it's a strategic hedge against rising regional tensions. As a result of Japan's sell-off, the global bond market is being shaken. This could lead to increased borrowing costs for countries and businesses that rely on U.S. debt, affecting everything from home loans to auto loans. In particular, interest rates on loans and mortgages may rise, making it more expensive for individuals to